Earnings Power Value and Franchise Valuation. Lecture 15. Lecture Outline. Hello, welcome to Lecture 15 of Equity Master Secrets. This lecture is on earnings power value and franchise valuation. So first we'll talk about earnings power value, and we'll first look at what EPV means. So EPV will stand for earnings power value. We'll then look at the assumptions behind EPV, and then we'll talk about how we can interpret it. Moving on from that, we'll talk about the importance of a franchise, and then we'll talk about the advantages and limitations of EPV. Finally, we will summarize what EPV is. Then we'll move on to talk about a franchise, so how do we value a franchise? Next, we'll talk about the key points about franchise value. Then we'll talk about the advantages and limitations of franchise value. And finally, we'll conclude. So this lecture is really going to continue our discussion from last time about valuation. So we're looking at some new valuation methods, in particular earnings power value. Alright, so let's get started. Earnings power valuation. So in the previous lecture, we saw asset-based valuation, which was the first of our three valuation methods. In this lecture, we're going to talk about another type of valuation, which is called earnings power valuation. And to summarize what we did last time, asset-based valuation can be used where firms either earn less than their cost of capital or are just about to match the cost of capital. So in particular, that means that there's no competitive advantage for the firm, right? And that's why we don't really need to consider earnings, because if the firm's going to be simply making returns equivalent to their cost of capital, then there's no additional value being created. So let's say, for example, if a firm had a cost of capital of 12%, and the return on equity or return on invested capital of the firm is also around 12% or 10 to 12%, just under 12%, and this is something sustainable, so this is something we've seen over a period of years, then it makes sense to use asset-based valuation rather than any of the others. And that's because it uses assets, and we don't have to worry about forecasting earnings growth. So it's a good valuation technique when companies have no competitive advantage. And ABV's entire focus is on the valuation of assets on the balance sheet, right? So it's basically an approach that's only going to look at the balance sheet and not worry about what the profits of the firm are. And we do not aim to value the earnings or the cash flows of a company. So it's really quite different to, for example, discounted cash flow, which we talked about last time as well, which only takes into account cash flows. So now I want to ask the question, well, what happens if a firm consistently earns more than its cost of capital, right? So if a firm is earning, let's say, 15% ROE and their cost of capital is 12%, then what do we do? And for these types of cases, we'll use what is called the earnings power value method. So the first thing to note is that if a firm is earning more than its cost of capital, then the asset-based valuation method will not work, right? Because if the firm is earning more than its cost of capital, it means it has some competitive advantage, and we need to somehow factor that into the valuation. So let's say we have a cost of capital of 12%, and we have ROE or ROIC is 15 to 20%. So this is considerably higher than the cost of capital. In that case, we should use the earnings power value method. Okay, so this is really a method that's going to be used to deal with companies that have a competitive advantage or have an economic moat, like we talked about before. And frequently, these are the types of companies we're interested in investing in. So this is definitely a methodology that we make heavy use of, the earnings power valuation method. And that's because of the fact that it's able to take care of companies that are earning significantly higher than their cost of capital. What does EPV mean? So earnings power value, the way we determine it is that we use the current earnings of the company after making all the adjustments. So when we use earnings power value as a method to value a company, we're going to be using primarily the current earnings of the company. And we're going to take those earnings and we're going to make some adjustments, and we'll talk a little bit about what we're doing there. But essentially, you can think of it as using just the current earnings to value the company. And since we're only considering current earnings, future earnings and cash flows do not enter the picture. So obviously, if a company has a competitive advantage, right? We cannot use asset-based valuation. We have to consider a method that takes their earnings into account. And discounted cash flow, which we talked about in the last lecture, suffers from the main shortfall that it's very difficult to forecast cash flows a long way into the future. And also, getting the right discount rate is not easy as well. So there's high amounts of error when it comes to discounted cash flow valuation. But when we use earnings power value, we're able to still take into account earnings, but we're not having to worry about future earnings or future cash flows. So we only use current earnings when we're using earnings power value. And what kind of adjustments would we be making? Well, the adjustments to earnings would be not including one-time charges or adjusting for maintenance, depreciation, etc. So because we're considering current earnings, we have to look at current earnings, and we need to think about, well, what would be the normal earnings for this type of company, right? So if there's a one-off charge that's not expected to occur again, then we would not include that when we're thinking about what is the company's current earnings. So one other adjustment that we might want to make is that suppose we have a company in the cyclical industry, then there might be wide swings in earnings during the peak and downturn of the business cycle, right? So when the economy is doing well, maybe the earnings are a lot higher. When the economy is not doing so well, the earnings are a lot lower. And in these cases, we would actually come up with an estimate of a normalized earnings, right? So we might want to take the average of these or something like that, right? So consider independent of the business cycle, what is their earnings. So our idea when we're looking for the current earnings is to get an idea, to get a picture of the company's current earnings, as if it were, representative of a typical earnings that this company would make, right? So that means we take out a lot of one-time charges, we adjust for maintenance, depreciation, and if the company is in a cyclical industry, then we have to adjust for the fact that, depending on where we are in the business cycle, the earnings could be different. Okay, so that's the first step when it comes to EPV, is that we take current earnings, and then we make the adjustments necessary in order for those current earnings to be representative of what we believe would be a normal earnings for that company, right? And then, we can use current earnings as well as previous earnings, in order to determine what we think a normal value for earnings should be. Assumptions for earnings power value. So earnings power value was discussed by Graham and Dodd, and they made certain assumptions with respect to EPV. So the first assumption is that current earnings, properly adjusted, are considered to be nearly the same as cash flows to shareholders. Right, so ultimately we talked about the value of an investment as being, the value of the discounted cash flows, the discounted future cash flows of the company. So when we do earnings power valuation, we use current earnings, but we make the assumption that once we adjust earnings correctly, then this is about the same as cash flows to current shareholders. So this method is really suited for firms where earnings remain constant and are not likely to increase by much in the indefinite future. Right, so because we're not going to forecast future earnings, we're only going to use current earnings. Our implicit assumption when we do that is that, these current earnings are stable, and that, the current earnings will continue through time, and, there'll only be small increases, perhaps to account for inflation or just, very, very small growth. But the point is that we expect that these earnings will be constant over time. So when we make these assumptions, we can come to the following formula for the valuation of a firm using earnings power value. So we take EPV is equal to adjusted earnings times 1 divided by the discount rate. So essentially you're taking the adjusted earnings and you're dividing by the discount rate. So let's say that was 10%. Suppose your adjusted earnings were 1,000 and your discount rate was 10%, then your earnings power value would be 10,000, right? So very straightforward calculation. And R here refers to the current cost of capital, right? So we would look at, what is the cost of capital for the firm, and use that to use that as the discount rate. And we're not incorporating any growth in this formula, right? So if you remember in the DCF formula, we had R minus G in the denominator. So we would take the discount rate minus the cost of capital, minus the growth rate. So in this case, we're assuming the growth rate G to be 0, so it just becomes adjusted earnings times 1 over R. And then this is our formula that we use for earnings power valuation. So one other note to make about this kind of formula is that this type of formula is the result of, when you sum the same earnings over and over in repeated periods, but you're discounting each one, this formula represents sort of the infinite sum. Okay, so what this formula is saying is that if adjusted earnings were to continue into the future indefinitely, meaning for all periods into the future, then this would be the right way to calculate the value, right? We take adjusted earnings and divide it by the discount rate in order to get the value, with the assumption that these earnings continue indefinitely into the future. How does one interpret earnings power valuation? So there's actually a very close connection between EPV and ABV that we studied in the previous lecture. And we can evaluate this connection by considering three scenarios. So firstly, let's recap, right? When we do asset-based valuation, we use the company's assets, right, to come up with the valuation. And with earnings power valuation, we just use the company's current earnings adjusted as we need to adjust it. So how are they connected to each other? So let's suppose in the first scenario, so we're going to look at three different scenarios. Suppose in the first scenario, the company's EPV is substantially below the reproduction cost of assets. Okay, so that means that the valuation from EPV is much less than what would be the valuation using asset-based valuation. So what this implies is that the management is not using the assets to maximum potential to earn the kind of returns that it should. So if the assets tell us that the valuation of the company should be a particular number, and based on the earnings it's actually much lower, it means that the assets are not being used properly, right? It means that management is not doing a good job, and it means that they would have to change the way that they are doing things. So in the second scenario, suppose that the company's EPV is equal to the reproduction cost of assets, right? So in this case, we're going to take the two valuation methods and come out with the same value, right? Or almost the same value. And this situation will typically arise in highly competitive industries. So let's think about what this would mean, right? So theoretically, if you think about the EPV and the APV being the same, it should mean that the returns that the company is generating is roughly equal to the cost of capital, right? Because if the returns were higher than the cost of capital, then we would see the EPV be higher than the asset-based valuation. If the returns were lower, then we would see that they were actually making less than the cost of capital. And if they're the same, then we would assume that they're making around the cost of capital. In which case, we said that if a company's earning around the cost of capital, then it makes sense to use asset-based valuation. And this can typically arise in highly competitive industries, right? So industries where there's lots of competition and, kind of mature and stable industries, and hence their earnings are not much more than the cost of capital. Alright, so let's now look at this scenario in a little more detail. So let's see how that actually works. We can do the math and kind of see that this will work. So suppose we have a company A that's operating in a particular industry, okay, and we take their earnings and we adjust it properly, right? So we take care of the one-time charges. We maybe adjust it for cyclical reasons of the business cycle, whatever we need to do. We adjust it properly and we come out with earnings of rupees 10 million per year. How does one interpret EPV? So, building on the example we just talked about, suppose the company has a cost of capital of 10%. So to remind you, they had an adjusted earnings of 10 million. So if they have a cost of capital of 10%, then we apply the formula and we get the EPV of 100 million, right? So we take 10 million divided by 10%, so that's 10 divided by 0.1, and we get 100. And then suppose the cost of assets using the reproduction cost method of the previous lecture is just 30 million, right? So suppose that if we're looking at the asset-based valuation method, we come out using the reproduction cost method of a value of 30 million, then we have a differential of 70 million, right? So what does this mean? It means that if we invest 30 million, right, which is the reproduction cost, right, so that's what it would cost us to create this company. If we invest 30 million, then we have the potential to generate earnings worth 100 million. So that's a good thing, right? And what would happen is that this would attract other players into the industry, right? So suppose it is the case, right? Suppose it is the case that the EPV is much higher than the asset-based valuation. Then this would attract other competitors into the industry. So let's assume that another company, company B, enters the industry. And then perhaps because now there are two players present, right, then the profits of the company A fall, right, which is what we expect. Whenever there's more competition, we typically expect profits to fall. So then company A, for example, sees its earnings reduced to 8 million per year as a result of the competition. And once the earnings are 8 million per year, then this would translate into an EPV of 80 million. Okay, and there's still a considerable difference between the reproduction cost method and the earnings power valuation method. So they're still earning, significant returns. Then what will happen in this situation is that we'll have more players who will enter the field until the EPV equates the reproduction cost of assets. So what should happen over time is that more competition will come in. This will drive earnings down to the point where companies are earning their cost of capital, and then the EPV and the ABV give us the same valuation. And typically, we would expect to see this in industries where barriers to entry are quite low. So one example is commodity-type businesses. And in general, the assumption that new competitors will come into the market and lower profits, that depends on it being easy for new competitors to enter the market. It depends on the industry in question here. So some industries have low barriers to entry, making it easy for newer competitors, while other industries have very high barriers to entry, making it quite difficult for competitors to come in. So this type of thing is not guaranteed to happen, but in certain industries it certainly is likely to happen. And competitors enter the industry, and ultimately they drive down excess returns to the same level as the cost of capital. Okay, and once that happens, then the earnings power value will be the same as the asset-based valuation, and then we could theoretically use either of them to value the company. How does one interpret EPV? So now in our final scenario, let's now assume that the EPV is significantly higher than the reproduction cost of assets, and we're going to assume now that it's going to stay this way for some time. So this is going to be different to our example last time, right? So in the example last time, we saw that the EPV was higher than the reproduction cost. There was a big gap, but as a result, competitors entered the industry and ultimately drove down EPV, and it became the same as the asset-based valuation method, right? Same as the reproduction cost. So now let's consider scenarios where this is not the case, right? Let's consider scenarios where EPV is significantly higher than reproduction cost, and it is likely to stay this way for some time. So this means that the company is operating in an industry where barriers to entry are high, and where competitors are not able to drive down returns to the cost of capital. So this type of company would have what we call a moat, right? And we've talked about moats before, and we can think of this as a competitive advantage. And this means essentially that they are able to earn returns above the cost of capital, and in addition, they are able to do so consistently because it is difficult for new companies to enter the market, right? So there are no new companies entering the market that will drive the cost of capital lower. So as a result, they operate in an industry where barriers to entry are high, and they're able to earn, higher returns than their cost of capital over a significant period of time. And the key thing for this type of valuation, or this type of situation, is that EPV has to be higher sustainably, right? So it must be the case that the barriers to entry are sustainable at the current level for the indefinite future, right? So often this is something that's not that easy to figure out because, let's say we're in a situation where the EPV is higher than the asset-based valuation, and then one of two things could occur. Either we'll see competitors come into the industry and erode away those excess profits, drive returns to the cost of capital, or we might see that not happen, and then they'll continue to earn high returns over the future. And sometimes it isn't clear which one will occur. There's industries where maybe there are some barriers to entry, but they're not extremely high, so competitors still may try and come in, but it's not clear if they'll be successful, for example. Again, all these things are subject to certain assumptions, and we have to keep in mind that when we're looking at a company where they're earning above the cost of capital, we really need to have a good reason and a good justification for why we think that the barriers to entry will continue in the future, and that the company will continue its high level of earnings going forward indefinitely. So that's one of the challenges of EPV, but certainly something that we can overcome, and something that through good analysis we can certainly figure out. Importance of a franchise. So what is a franchise? Well, if we're taking the difference between EPV and the asset value, this is what we call the value of the franchise enjoyed by the company. And the defining character of a franchise is that it allows the company to earn more than it needs to pay for the investments that fund its assets. Or in other words, the company is able to earn more than its cost of capital and is able to do so on a consistent basis. And because a company can do this, it means there'll be a difference between the EPV and the ABV, right? Because the company is earning more than the cost of capital. And this difference between the two numbers, that is the franchise value of the company. So what do we need for this to occur? Well, as we said in the last slide, that we need it to be the case that the company can sustain the higher earnings in the indefinite future, right? So they need to have a strong competitive advantage, and this also needs to be sustainable over time. And we should also note that, as we mentioned, the franchise concept is nothing but the economic moat of a company that helps it to earn significantly higher than the cost of capital. So when we talked about economic moat in prior lectures, this is the same thing as franchise, or the same thing as the franchise value of the company. And it is it is something that allows the company to earn returns that are above its cost of capital. And in general, if we find that the EPV is much greater than reproduction cost and the difference is sustainable, then the firm is said to have a significant or sustainable competitive advantage, with its value being the difference between the two. Okay, so one thing to note is that, when we're looking at, say, these two different valuation methods, we do need a significant difference between the two, right? So we need a significant difference between EPV and ABV in order to say that the company has a competitive advantage. And small differences are typically not good enough. And that's simply because, with any type of valuation method, there's always going to be some error involved in estimating the right value, right? Different methods will give you slightly different numbers. So we have to keep that in mind. We should see a very large difference between the two. So we know that it actually is the case that the EPV is much higher, and perhaps the company does have a competitive advantage. And learning about the sustainability of a competitive advantage, this is one of the trickier parts of evaluating a company. And this is really something that will come with, experience and knowledge of companies in the industry. And specifically over time, when you get to observe an industry over time, or observe companies over time, you'll see what kind of industries attract competitors, or what kind of industries make it very hard for competitors. When do competitors fail, when do they succeed, etc. So a lot of work goes into understanding whether or not the EPV, when the EPV is higher than the ABV, whether or not this is sustainable for the long term. Advantages and limitations of EPV. So let's now talk a little bit about why we like to use EPV. So what are its advantages, and also what are its limitations? So one of the main advantages of EPV is that it considers current information without having to make predictions for the future. So when we're looking at earnings of a company, right, we can compare this to the discounted cash flow method, and this is particularly where EPV has its advantage. With discounted cash flow, we're typically having to forecast cash flows into the future, right, and we're having to make predictions of future cash flows. And when we use EPV, we don't need to do this. We do not need to worry about making these making forecasts for future cash flows. And as a result, we only need to consider current information. So that's one big advantage. And that's because we know that when we're forecasting cash flows, there is a high degree of error involved. We could certainly be wrong. So it's good that we have a valuation method that only uses current information. So it can be considered more reliable than assuming the rate of growth and cost of capital many years into the future, right? So with DCF, we have to assume a growth rate for the company into the future. We also need an estimate of the cost of capital into the future, which again, both of these things are uncertain, and whenever we forecast them, we're likely to make mistakes. So EPV is in that sense more reliable than DCF for these reasons. Now, one of the main disadvantage or limitations of EPV is that it is based on earnings, and earnings are less reliable than the value of assets. So in particular, we can compare this to the asset-based valuation method. And asset-based valuation method obviously doesn't take into account future earnings. It doesn't take into account current earnings. So it can't value companies which have a competitive advantage. But asset-based valuation is good because assets are actually quite reliable. They tend to be more reliable than earnings, and they're less difficult to fudge. So that's one reason why. So EPV has this one limitation, that because we're using earnings instead of assets to value the company, perhaps this is less reliable. Right? And that's because earnings can fluctuate a lot more than assets do. So, if we're using current earnings, that may not necessarily be representative of what the company is going to earn in the future. So these are some of the main, advantages and limitations of EPV. But certainly, taking all of this into account, EPV is definitely a very useful method, and it's one that we make heavy use of. And simply because, it's able to deal with, companies with a competitive advantage, right? It's companies with earnings above their cost of capital, while at the same time not having to worry about future cash flows or forecasting future cash flows, right? So those are kind of the two big advantages for this type of method, and that's why we like to use it. Summary of EPV. So let's now conclude our discussion on the earnings power valuation method and summarize what we've done so far. So in this lecture so far, we've discussed the concept of earnings power value and its importance as a measure of a firm's intrinsic value. And since it takes into account current earnings, it is more reliable in estimating earnings and cash flows into the future. And we just talked about this. This is its main advantage over DCF. And if the EPV is substantially higher than the asset value for a company, that means it enjoys what is known as a franchise, right? And this means that it can earn above the cost of capital. So putting all this together, we now have two methods of valuation, right? So I'm ignoring DCF here because, as we said, we don't tend to use it due to its high practical limitations. But two ones that we tend to use, the asset-based value and earnings power value. And whenever a firm is earning the cost of capital or slightly less than that, we use the asset-based valuation method. And the asset-based value method, we either have the liquidation method or the reproduction cost method. And then the second method is the case where return on capital is greater than the cost of capital, but there is no growth in earnings cash flows for the firm. So this is the EPV, right? We assume that we earn more than the cost of capital, but we do not assume any growth rate for the company's earnings into the future. And now that we've have these two methods of valuation, this is certainly a good toolkit to have, and we can definitely get started with it. Now we want to talk a little bit about a franchise, right? So we said a franchise was essentially when a company's earning more than its cost of capital, right? Its EPV is going to be higher than its ABV. And the difference between the EPV and the ABV is what we would call the franchise. Okay? So our next goal is now to value this franchise, right? So we know how to value the assets of the company, and how do we value this difference between the assets and the EPV, right? And this is kind of going to be related to issues of, how sustainable is it, and what kind of advantage is it? Do we expect competitors to come in, etc. Right? So we want to spend a little bit of time. We're going to spend the remainder of this lecture talking about how to go about valuing a franchise. How to value a franchise. So now we're going to spend the remainder of this lecture talking about how to value a franchise. So as we mentioned before, franchise value is simply the difference between the asset value and the EPV of any company. And we talked a little bit about when these would differ, right? So typically if the company is earning returns that are significantly in excess of their cost of capital, then the EPV is going to be higher than the asset value, right? So when we have situations like these, so when a company is earning more than the cost of capital, or a company has an economic moat, then we would say that the company has franchise value, right? The excess of the difference between the EPV and the asset value. So now we want to spend time talking about this franchise value, so this difference, and look at how do we value that, and also talk a little bit more about different features of the franchise value. So the best way to see how to value a franchise is just to go through an example. So we'll go through a hypothetical example. So let's start by looking at the earnings power value of the company. So as we mentioned before, the earnings power value is simply the adjusted earnings times 1 over R, where R is the current cost of capital. So suppose in our hypothetical example, we have company XYZ that has earnings of 25 million. And assuming that a cost of capital is 8%, then we get the EPV value of 313 million. Right, so this will just be 25 million divided by 0.08%. So now that we have the EPV, which we can see is pretty straightforward, obviously in order to get that we had to first adjust the earnings. So we came up with these adjusted earnings of 25 million. And as we've seen throughout this lecture, there are a number of steps you have to take in order to get to the adjusted earnings amount. right? So once we have that, then getting the EPV is very straightforward. So the next thing we want to do is estimate the asset value or the reproduction cost of assets. So the asset value is simply the book value of assets with some adjustments made. So suppose, for example, that the total assets of the company, so taking into account the tangible plus the intangible assets of XYZ, are rupees 70 million. Okay, and what we'll see is that, we're going to start with total assets, and then we'll have to make some adjustments in order to come out with the asset value of the company. So this franchise value, is quite an important concept, because it's really telling us, a company that has a competitive advantage, right? What is that competitive advantage worth, right? We're trying to, in essence, value, the company's competitive advantage. That is, the fact that they can earn above the cost of capital and do it sustainably. Well, what is that worth? How much are we willing to pay for that, right? That's really what valuing a franchise is all about. Okay, so let's now go ahead and we'll continue with this example. How to value a franchise. So continuing with our example, we started off with we got the assets of the company, right? The book value of assets. And the next step is to find the reproduction cost of assets, which is going to include some adjustments. So suppose, for example, that XYZ Limited has a strong brand and is a highly profitable company. And as a result, competitors are lured to enter the industry. And well, what would happen as competitors enter the industry? Well, as we know, profits tend to fall, right, when there's more competition. So one mechanism by which this occurs is that the company would have to spend more money on advertising and promotion because they would want to compete with XYZ, right? So, for example, if a competitor were to come into the market, right, they would be competing with XYZ, and they would have to spend higher on advertising and promotion as compared with XYZ, right? So here we're looking at the reproduction cost of assets, and we're seeing, well, we would have to spend more in order to reproduce that. So when we correctly estimate the reproduction cost of assets, advertising and promotion expenses have to be capitalized. So capitalized means we take them to the balance sheet rather than report them as an expense all in one period. So though they are recurring in nature, the benefit of these expenses is realized in future years in terms of increased market share. Hence, they can be considered as off-balance sheet assets. Right, so even though advertising and promotion is an expense, what it's really doing is creating brand value, right? And this brand value should hopefully result in increased market share over time. So as a result, we would consider this as an off-balance sheet asset. So within 1 year, we would see that a competitor cannot pose any material threat to XYZ Limited, right? And that's because of the fact that XYZ Limited has a strong brand, right? And in order to reproduce that brand would take a long time. So in 1 year, we would say that there's no material threat to XYZ Limited. So we would need to decide the period, i.e. the number of years over which the expenses have to be capitalized. All right, so if we're taking these advertising and promotion expenses, we would want to decide, well, how many years do we need over which the expenses have to be capitalized? And this is kind of thinking, well, how many years of advertising and promotion would it take to actually build a strong brand, right? In order to be a material threat to XYZ, how many years would it take, right? And obviously, this is something that's not trivial because it's subject to a lot of error, and how long it takes for consumers to switch brands is the subject of a lot of research. But certainly, we can try and come up with some good estimates for this, and then we'll take it from there. How to value a franchise. Okay, so as we said, deciding on the number of years depends on your judgment of how long the competition will take to build a brand as strong as XYZ Limited and replicate its distribution pipeline. So as we said, it may be difficult to do this because it's not always clear how long it would take to build a brand, right? Because a brand is something intangible. It's not like building a factory where you can, quite easily, or at least more easily, forecast how long it will take. When it comes to a brand, that's more difficult to do. But suppose for the sake of simplicity, we just assume that it takes 3 years, okay? So suppose that we are in this particular industry, it'll take about 3 years to build up a brand, and the total advertising and promotion capitalization cost will be 50 million. So now our reproduction cost of assets will be the initial 70 million, right? That was the book value we had initially, plus 50 million, which is going to be 120 million. Okay? So this is saying the book value of assets plus the advertising and promotion capitalization cost gives us the new reproduction cost of assets. And then the next set of adjustments we'll make some additional adjustments to the balance sheet. So first we'll reduce spontaneous liabilities like advances from suppliers, workers. So let's say, for example, that was 20 million. So we would get rid of the 20 million in liabilities. And then we can also deduct cash in excess of what the company needs to run the business. And let's suppose that that's 10 million. So really what we're doing here is we're trying to get rid of things that we may not necessarily have if we were trying to reproduce this company, right? So we may not have the advantage of advances from suppliers. So we would take that away from spontaneous liabilities. We wouldn't also necessarily need cash in excess of what it needs to run the business. By definition, if it's in excess of what you need to run the business, you don't need it to run the business, so we can take that away. And spontaneous liabilities are reduced, as we said, as it reduces the outgoings of competitors. Advances from suppliers reduce the investment in working capital. And excess cash is reduced as competitors can invest the same in other profitable areas. Okay, so throughout this process, we're going to end up, making a few adjustments, right? And the important thing to keep in mind when we're making these types of adjustments is that it should tie back to the central point that we're trying to follow, right? And the thing we're trying to do is we're trying to see, well, what is the reproduction cost of assets, right? If a competitor were to come in and reproduce this company, what would it look like? That's really the question that we're trying to answer. So, even if these adjustments seem ad hoc, they're actually all tied to the central theme. And whenever you're making adjustments yourself, you want to be able to tie it back to that question, right? What is the reproduction cost of this company? How to value a franchise. Okay, let's now go ahead and see what the valuation looks like from our example. So let's adjust for the total, adjust these items' total reproduction cost of assets, and here's what we would end up with. So we had total assets which were 70 million. Okay, so that was what we said initially. And then we were to add 3 years of advertising and promotion expenses, and we capitalize this, and this would be worth 50 million. Then we deduct the advances from suppliers of 20 million. And we deduct the excess cash of 10 million. And then we get a total net reproduction cost of 90 million. Okay? So what does this number mean? It means that this is the amount of money we would need in order to reproduce this company. Essentially, that's what this means. So let's compare this to our initial estimate of earnings power value. So our initial EPV estimate was 313 million. And as we said, the franchise value is equal to the earnings power value minus the reproduction cost. So in this case, we'll have 313 million minus 90 million, and this will give us a franchise value of 223 million. And this number is quite good, right? Because what we can see is that, the EPV is a lot higher than the reproduction cost, right? Significantly higher by, more than double. In fact, more than triple. So that's very good. So what does it mean that when the company has such a high EPV relative to its reproduction cost? So the firm's franchise value obviously is going to be increasing in EPV. And essentially, if the EPV were equal to the reproduction cost of assets, right? So if we ended up with a reproduction cost that was equal to the EPV, we would have a franchise value of 0, right? And this typically would mean that the firm is earning the returns equal to its cost of capital. But since it is much higher in this case, it means that the firm has some sort of strong competitive advantage or a franchise. And this exists because the firm's return on capital is much higher than the current cost of capital. Okay, so if they're earning returns in excess of the cost of capital, then you will see this positive franchise value. So on reproduction assets of 90 million, it has earned 25 million, right? So if you think about suppose we were to reproduce this company and it would cost us 90 million, okay? And the earnings of the company were 25 million. That means that the return on capital invested is 28%, right? Which is really high. So that is a lot higher than the cost of capital, which we started out with as 8%, right? And this signals the existence of a strong franchise. So this is kind of, a good intuitive understanding of, franchise value and how it relates to the cost of capital. Key points about franchise value. So let's now talk a little bit about some of the key points about franchise value. So the first thing to note is that franchise value increases if EPV increases and vice versa. And this is quite easy to see from the formula for franchise value. Right? Franchise value is simply equal to EPV minus the asset-based value or reproduction cost. So when the EPV goes up, franchise value will go up as well. And when EPV goes down, franchise value will go down. EPV is also positively correlated with profitability, right? So if the profitability of the company XYZ increases, then EPV is going to increase, right? Because EPV is just earnings divided by the cost of capital. So if earnings go up, then EPV goes up. And this can happen over time if competitors are not able to make any inroads into the market share of the company. So on the other hand, there will be instances where competitors can make inroads, and suppose competitors cut their prices, spend heavily on marketing, they were able to take away market share from XYZ. And this will reduce the profitability of XYZ, right? Because the earnings would come down. Earnings coming down mean its EPV would also come down, and then its franchise value would come down. So as a result, franchise value is dependent upon how successfully the company is able to maintain its market share and profitability. Right? One of the key things to remember about valuation is that, firms and industries do change over time, right? So we may look at a company's earnings now, but we cannot just automatically assume that that's going to be the same in the future. Right? So when we do the EPV calculation, it's based on the assumption that earnings are not changing over time. Right? So we really have to be quite confident that when we're analyzing this company, that there are good reasons for why this earnings should stay constant over time. Right? So when we're looking at the company's franchise value for XYZ, we need to have good reasons to assume that they will maintain this earnings going forward. Right? So that's really important. So it really needs to be the case that the company is able to maintain its market share and profitability. And if the company is not able to do that, then the franchise value will fall. So obviously the company needs to have a strong competitive advantage, right? And the competitive advantage needs to be sustainable. So, we looked at this earlier on in the course, right? We looked at different types of competitive advantages that companies can have and what types are more sustainable than others. So this really comes down to one's own judgment, and through experience and observation of companies and industries, we'll get a better idea of what types of competitive advantages exist and, how sustainable are they. And naturally, if it's not sustainable, then the EPV will fall over time and the franchise value will also fall. Right? So this is very important. It's really important that not only can we do the calculations and find out the franchise value, but also keep in mind the assumption that franchise value depends on the fact that the firm maintains its market share and profitability over time. Advantages and limitations of franchise value. So now let's talk, we're now towards the end of the lecture, so let's talk a little bit about the advantages and limitations of franchise value. So one of the main advantages of franchise value is that it involves inputs which are less subjective in nature. Right, so franchise value is based on earnings power value and the assets, both of which are easily observable. Right, so unlike, say, DCF, where you have to forecast future cash flows, you don't have to do that with franchise value, so the inputs are less subjective. And figures like earnings, book value of assets are quite easily available. Right, so it's pretty easy for us to calculate the franchise value and to get a good estimate of that. So one limitation with franchise value is that it is susceptible to changing values in the cost of capital. So one of the things that happens when we, for example, calculate the earnings power value, that's equal to the earnings divided by the cost of capital, right? And again, implicit in that assumption is that one is that earnings will stay constant over time. It is also implicit that the cost of capital stays constant over time, right? So franchise value has the assumption within it that the cost of capital is staying the same over time. So naturally, if cost of capital changes, then franchise value is going to be different. So suppose, for example, we increase the cost of capital to 10% instead of 8%, right? Then the franchise value is going to fall, right? Because a higher cost of capital means that the EPV falls, right? And that means the franchise value falls. And that means that also your returns are closer to your cost of capital as compared to before, right? So franchise value will fall when cost of capital increases. Vice versa as well. If cost of capital were to decrease, then that would increase the franchise value. And unfortunately, sometimes forecasting the cost of capital is not that simple because, it depends on, for example, in the case of debt, it may depend on interest rates at the time whenever the company issues debt. And it's also the required return. It also depends on the required return for equity holders, and that can also change over time, depending on things like risk aversion and such, or things like inflation as well. Another limitation of franchise value is that if companies frequently change their accounting techniques to record transactions, franchise value estimates may not be accurate. And this is a more problem with the account side of things. Like if the company's accounts themselves are highly volatile because of different methods, then obviously those accounts are not going to be as accurate, right? So at the end of the day, your analysis and your estimates is only as good as the numbers you put in. So if the numbers from the accounts that you're putting in are highly variable, or maybe a little dodgy even, then obviously the numbers you're going to get are not going to be that great either, right? So there's a good saying for that called garbage in, garbage out, right? So we have to make sure the numbers we're putting in, are reliable, and also the accounts are, consistent from year to year. So it's easier for us to, estimate that, accounts will stay and earnings will stay constant over time. Conclusion. So this now brings us to the conclusion of our lecture on earnings power value and franchise value. So we talked initially about earnings power value in the first part of the lecture, and in the second part of the lecture we've talked about franchise value and what it indicates. So I won't talk about earnings power value because we already did a conclusion and summary on that earlier. So let's look at franchise value and summarize what we've done. So it takes into account book values, and it is less reliable for companies that fudge books or change accounting methods frequently. So as we mentioned on the last slide, if their accounting methods constantly change, then this is not necessarily a good way to go about things, because it means that the accounting values would also change over time. And what happens is that if we find that the franchise value is substantially higher, then we need to find out the competitive advantage that the company enjoys, right? We need to actually understand, qualitatively, what is the company's competitive advantage, right? So this is the franchise value is a way of quantifying the competitive advantage, right? It's saying that, the difference between the earnings power value and the asset-based value is the franchise value. This is the value of the company's competitive advantage. It's the quantitative value of the advantage. We also need to have a qualitative understanding of the advantage, because that qualitative understanding tells us whether or not that advantage is sustainable or not, right? It's a qualitative understanding that will allow us to actually say, will the company be able to sustain this advantage going forward, or will this advantage disappear over time? So that's really important. Alright, so that concludes this lecture. Now in the next lecture, we're going to talk about another variant of EPV approach. So we'll continue talking about valuation and EPV. We will also move on to some case studies, real-life case studies on valuation, and we'll use the approaches that we've discussed so far. So naturally, obviously, understanding the theory, and in these cases, we've looked at hypothetical examples. Hopefully, that's built your intuition well, so you understand, how exactly these type of methods work, and importantly as well, what are the limitations and advantages of different types of methods. The next step is, of course, to look at some real-life examples, and we'll do just that in the future lecture. So we'll look at real-life examples and see how to apply the concepts that we have learned so far. Okay, so thank you very much for listening, and see you next time.